About 18 months ago, Washington was neck deep in the outcry about energy speculators. Those complaints fueled, of course, by oil prices hitting their all-time high back in July of 2008. Now, the Commodity Futures Trading Commission is proposing one step to its members that they think could keep that from happening again: position limits on energy traders. Executive Editor Margaret Ryan is joining us now and has been following this possibility for months and months now. Margaret, this is just a step in the direction, correct?
Absolutely, it is a step. Now, you recall, as you mentioned, the CFTC was absolutely in the eye of the storm in 2008, accused of neglecting to regulate the energy derivatives markets while speculators from Wall Street wreaked havoc on American wallets. So yesterday, led by Obama-appointed Chairman Gary Gensler, the CFTC proposed limiting how large a market position any single energy trader can hold. Now, the proposal affects the billion-dollar markets for futures in crude oil, natural gas, home heating oil, and gasoline. The proposal would limit a trader to holding 10% of the first 25,000 open interest market contracts for all months. When the number of contracts outstanding for a month exceeds 25,000, the trader could then hold no more than 2.5% of the balance. The CFTC says only 10 large firms will be affected. It didn't name the firms. The CFTC members worried that the limits could just drive derivative traders overseas, which wouldn't help rein in speculation. Gensler and Democrat Bart Chilton expressed the fewest reservations, while Democrat Michael Dunn and Republican Scott O'Malia worried the limits would have unintended consequences. And Republican Jill Summers voted against even proposing the limits. The CFTC will decide whether to adopt the rule after a 90-day public comment period. So, Tyler, probably no sooner than about 4 months from now.
Let's go back, Margaret, to what we call the outcry here in Washington in the summer of 2008. I remember attending a press briefing with members of the airline industry talking about how high prices were, what it meant to them. What happens to companies like the airlines who use these derivatives to hedge their fuel costs, and those savings, if that's what they are, trickle down to us as consumers?
Oh, well, with the companies like airlines, barge companies, shipping companies, they're exempt. As are the traders acting directly for them. The CFTC, lawmakers on Capitol Hill, nobody wants to actually kill off the derivatives market. I mean, it acts as insurance for these companies with large energy exposures, and you know, these companies have it built in to use this kind of derivatives market. The original idea of the derivatives, in fact, was to protect companies like this from yo-yo prices. You know, it's very hard to plan for a year ahead if you think your fuel prices are going to go like this up and down all over the map. Right. So, what's called in the industry a plain vanilla derivative is where a company like an airline gets a fixed price for the year from a third-party company, a financial company, which says, I'll take the risk of the price change. And for a given premium, just like an insurance policy, for a given fee, I will guarantee that you will pay this price for your fuel. Now, that company, of course, is taking a bet that the price overall, the average over the 12 months, is going to be in its favor and it will make money, but there's no guarantee. They in fact, may lose money. And that is where the problem really began, because these companies that were insuring companies like airlines and shippers wanted to lay off their risk. And so they began packaging, they began issuing derivatives on top of the derivatives, and the big traders, frankly, who should have known better, actually kind of lost track of their risk.
Well, what does that mean for us then, Margaret? If the higher costs will be passed down to us as Americans without potential regulations, does that mean we'll have lower costs necessarily with these things in place?
Well, nobody can say, because it will depend on the fundamentals of the market, and that has been the argument of the regulators here, that the futures markets got totally out of whack with the physical markets that that underlie them. Real futures markets are supposed to be telling you something about the future price of a physical commodity, but instead these markets developed their own fundamentals. They became linked in with other markets like foreign exchange. You had fast money globally making bets on price movements up or down, and moving across derivative markets in currency and energy and metals and agriculture, in effect decoupling all those futures markets from the underlying physical markets which they're supposed to represent. And that created havoc for people who were trying to deal in the underlying physical markets. So what it does here is it drives, first it makes those prices yo-yo even more in the physical markets, and that means companies have to, in the end, are going to pay more, and they're going to charge us more for their costs, or it'll cost them more just to stay in business.
Clearly a focus here on oil, because that's what fueled so much of the outrage in 08. But this affects oil and natural gas as well.
Well, it does, because the proposal here is for U.S. regulated futures. Now, you have a futures contract only if you're trading on a regulated exchange, and usually in a commodity that's fairly heavily traded, because a futures contract is a product of an exchange. There are many derivatives in energy that are written as well. They're custom written for a particular risk companies have, and there is pending congressional legislation that tries to bring a lot of that out into the open too. But the CFTC, and I should add, the CFTC is in the process of extending its regulatory reach to more offshore contracts that are written on based on U.S. products. But the effect here, I think, would be indirect, because it would give physical traders better, if it does in fact rein in speculation and rein in the effects of other markets that have nothing to do with the price of oil or the price of natural gas. It would give physical traders better information on which they can base, say, writing these derivatives for airlines and for shipping companies, and that means lower prices. Now, the new Republican member of the CFTC, Scott O'Malia, I'm sorry, I'm not sure if it's O'Malia or O'Malia, but he said the limits haven't worked to control speculation in agricultural products. There are long-standing limits in agricultural commodities. And he said, why are they going to work here? You'll recall that last summer there was a terrific amount of discussion about this driving trading offshore with very opposing positions staked out. Many in industry said, yes, traders will just take their money and they'll go overseas and you'll never know what's happening over there, but it'll affect your prices. And probably an equally adamant contingent of experts and some in industries saying, no, the U.S. markets are so large, nobody can afford to just depart from them. And in the end, after all the threats, you won't see that happen.
As we said, just a proposal at this stage. The public comment period begins, but we'll closely be watching it as well. Margaret, thanks a lot.
Thanks, Tyler.
More conversations between you and Gary Gensler to come, I'm sure.